Good afternoon, and welcome back to AIADA's Auto Talk. I hope you all had a great summer. I'm your host, Rachel Soleimani. Before we get started, a few quick reminders. Anyone who has registered for today's program will be receiving a copy by early next week. And if you have any questions, be sure to enter them into the Q&A bar at the lower right-hand side of your interface. Today, we welcome back our good friend, Cox Senior Economist, Charlie Chesbrough. Charlie, we're excited and maybe a little nervous to hear what you have to say today. So I'm going to let you take it away.
All right. Well, thank you, Rachel. And yeah, I think you're right to be a little bit nervous. There's certainly a lot of uncertainty out there today, but we remain cautiously optimistic. We see that the situation out there still remains positive. There's still a lot of good news stories out there, but certainly there's a lot of concern that a recession may be around the corner. And that's one of the things we're going to start talking about today. And really going through which brands may be vulnerable to this recession, because not everybody's in the same boat. And then I want to walk everybody through what we're seeing in the new and the used markets, particularly on inventory and prices. They're continuing to change and sort of headed in different directions, at least on when it comes to inventory. And then I want to finish up by talking about EVs. I've spoken about this before, but we are reaching that takeoff stage regarding electric vehicles. And so, like them or not, they're coming, and a lot more of them are coming. So we're going to talk about that and what's going on with them in the market today. But the big news where I'm at, which is up near Detroit, is the potential UAW strike. And the feeling is now is that it seems like there is going to be a strike come midnight on September 14th. And we're not exactly sure what the UAW's plans are, or who they're going to target. But there's been a couple offers floated around from the manufacturers to the UAW this week. I think thus far the response has been that the offers are insulting, but they're far apart. But we're talking about almost 144,000 UAW workers. Ford's got the most. Used to be GM, but now Ford has them. And we don't know what the UAW is going to do. They may try to target all three manufacturers, or they may just try to target one. And they might try to get strategic. They may actually go for certain plants, like a transmission plant or even a supplier, such that they could have just a few folks actually go on strike, but it could disrupt the whole supply chain for the Detroit 3 manufacturers and possibly other manufacturers as well, depending on what their plans are in terms of who they strike against. In terms of what the manufacturers themselves are, the situation, Chrysler, all of them have inventory starting to build. And certainly, I'll show you a slide here in just a few moments, that the big pickup trucks, their bread and butter, are really seeing inventory levels build quite a bit. But on the whole, Stellantis appears to have more inventory than some of their competitors. So they may be in a better position to take the hit if we saw production start to slow or shut down completely during this strike period. It's going to be expensive. It's estimated that if it lasted 10 days, it's going to be over $5.5 billion, with Ford taking the biggest hit. And it seems very possible that if it's a short strike, it's not going to have much impact. I don't think we'll even really notice it out there in the marketplace in terms of any impact on price or supply. But certainly, if this goes on for a long period of time, that all goes out the window, and we could start to see ramifications for certainly the Detroit 3 type manufacturers, but also others as well, as I said, if the supply chain gets hit. Right now, the union, last I heard, was asking for over a 40% increase in wages. They wanted cost of living allowances reinstated, pensions reinstated, and they're asking for a 32-hour work week, but being paid for 40. Sounds pretty good to me. I'm not sure they're going to be able to get it, but they seem very far apart right now. But we also saw a couple months ago when UPS was on strike, and it sounded like these two folks didn't like each other and they're never going to come to an agreement. And then all of a sudden they announced a deal. So there is hope out there that maybe behind the scenes they are working on things. But at this point, that's one of the major issues that we're concerned about there. But on the whole, we're looking at the economy. Things do appear to be getting a little bit better. And we'll start by looking at consumer sentiment. This is a long history of data of what the view is of consumers out there regarding the U.S. economy. And this is from the University of Michigan. And you can see over there on the far right, in June of 2022, we saw this measure go to the lowest point ever in this measurement. It goes back about 45 years. that consumers a year ago, last summer, were extremely pessimistic on where the U.S. economy was at. And that's taking into consideration the double dip recession we had in the early 80s, the S&L crisis of the early 90s, the 9/11 terrorist attacks, and of course the Great Recession. But last summer, when gasoline went over $5 a gallon nationally, and we saw inflation really start to rise quickly and aggressively, that sent folks into a very, very sour mood. But as you can see, the most recent period since that bottom that we had a little over a year ago, things have been moving in a better direction. There's a little bit more optimism out there, and in large part because the gasoline prices have fallen back, and much of the inflation issue has fallen back. But inflation remains public enemy number one out there. This is looking at the year over year change in the consumer price index. And you can see on the far right where we are today. We're looking at around a little bit over 3% was the most recent data point of inflation, well below the nearly 9% peak that we had starting last summer. That really kind of sent everybody into the tailspin. And that was because we hadn't seen levels of that level of inflation for over 40 years. You got to go back to the early 1980s. And so it does appear that the Fed has been able to address this inflation issue by raising interest rates. Their goal is to get this inflation down to the target, which is 2%. So we've got a little bit of a ways to go, and the feeling is it's probably going to take quite a bit of time to get there. But everyone's hoping that they can engineer this soft landing, that they can get inflation back down towards the 2% level without leading the economy into a recession, and certainly seeing the unemployment rate spike. And thus far, as I said, they've been successful at doing that. This is looking at the unemployment rate. And again, we've got a long data history here, over 70 years. And where unemployment stands today is really very close to historic levels. I mean, it's very, very low. We did have unemployment rate tick up a little bit in August, but the economy is still creating jobs. Almost 180,000 jobs created just last month. And so there's really nothing that we can look at in terms of the employment side of things to say that a recession is imminent, because it certainly looks like hiring is continuing. And as we saw, the consumer confidence out there is improving, inflation is coming down. So there's a lot of positive things out there to be cautiously optimistic that we're going to see continued growth of vehicle sales here throughout the rest of the year. But the main concern that everybody's really looking out there is the interest rate spread. It's really a dangerous signal out there for the economy. It's the yield curve inversion. And this data is showing the 10-year minus the 2-year treasury. So it's essentially the long-term interest rate minus the 2-year interest rate. And what's important about this is that historically, any time that the near-term rates have gone higher than the long-term rates, soon after that, the economy slips into recession. And really, the main reason for this is that in the banking sector, it's that banks that borrow short and lend long, they can't make money in that environment. When they have to borrow at a higher interest rate and lend at a lower interest rate, it's a money loser. And so when we look historically, this is showing a graph of the yield curve. You can see that anytime that we saw that spread go negative, very shortly, 6 to 12 months afterward, the economy went into recession. And that's what those red marks there are on the chart. Those are periods when we had a recession in the U.S. economy. And on the far right, you can see where we are today. The yield curve has been in negative territory since July of last year. And so many folks are looking at this indicator and saying, we may not be in a recession yet, but certainly it seems very, very possible, maybe even likely, that one is around the corner. I will say that some of the leading thinkers out there, like Goldman Sachs, their own view is that there's really just a 15% risk of recession here sometime in the next year. But they may be a little bit more optimistic than some other forecasters I've seen out there. But clearly, this is one of the big risks that we have facing the U.S. economy today. But it doesn't seem like the vehicle market is really under that much of a threat, even if we do have a recession. This is a chart that's looking at light vehicle sales. And on the left, I'm showing how annual vehicle sales behaved during the Great Recession period. And that officially started in December of 2007. And you can see vehicle sales were sort of humming along at a 16 to 17 million level. The recession came. We saw sales fall dramatically in 2008, and then they hit a bottom in 2009 of 10.4 million before we began a decades-long upward recovery from that recession. On the right, you can see new vehicle sales during this global pandemic period. And what we can see is that in 2019, sales were humming along at 17 million. COVID came, we saw sales fell. Then we had the supply chain crisis of 2021 and 2022. And we finished last year with 13.8 million. Um, and so if we have a recession, in many ways, we've already seen much of the loss that would normally happen from a recession. A lot of those buyers that would be pushed out of the market, your subprime folks, your lower income folks, they've already left the new vehicle market. They got chased out when COVID first hit. So if we do have a recession at this point, it would be more like falling off of a curb than falling off of a cliff. Our view is that the recovery of vehicle sales, or excuse me, the recovery of the inventory levels has really been one of the key factors in driving sales this year. And our expectation is we're going to finish this year around 15.3 million, about 1.5 million above what we did last year. And then looking forward, we expect sales to continue to rise, but just at a very, very modest level, as many of these headwinds do kind of suppress any kind of more significant sales growth. And certainly there's upside and downside potential to this. It's very possible that the Fed is not able to engineer this soft landing, that we do have a significant recession and inflation continues. There's talk that the Fed may have to raise interest rates further. All of that could sort of make a pessimistic scenario where that red line is. But there's also the optimistic view that the soft landing is achieved. We see that supply continues to recover. And that interest rates don't continue to rise. So we may have a more green or optimistic outcome. So it's quite a band of where we're looking for next year. But at this point, the rest of this year still looks fairly optimistic. Although our view is that we think sales are going to start to slow here as we enter into the fall, in large part because of many of the headwinds continue to remain of these rising interest rates that continue to rise out there in the marketplace, even though the Fed has paused raising rates. And much of the pent-up demand that had not been able to be fulfilled during the lean inventory environment, much of that has been fulfilled at this point. Certainly a lot of the fleet activity, which has been driving the vehicle market this year, the fleet companies have bought quite a bit this year. So we may not have quite as much demand out there to support the market, but it's still, there's no collapse that we can see in vehicle sales, certainly over the near term. At Cox Automotive, we also do a survey each quarter, the Dealer Sentiment Index, where we talk to dealers around the country and we ask them what is their view on the economy and how our vehicle sales where they operate. And you can see that in orange here, this is showing the franchise dealers, and in red is showing the independent dealers. And on the far right, we can see that franchise dealers still remain fairly optimistic. Anything above 50 is showing that you generally have a more positive view on where things are at today. But relative to independent dealers, certainly they're much lower. And I'm sure they've had a very difficult time being able to acquire inventory, and certainly at these higher prices. And certainly many of their customers have been hit especially hard by these rising interest rates. But we also ask dealers, what is their outlook? What are they expecting 3 months from now? And again, you can see on the far right that franchise dealers still remain fairly optimistic, that they're not expecting a major recession, at least a major impact on their own business here anytime over the near term. But one of the most important things is how is the inventory level out there and how are profits behaving? And both of those actually appear to be changing quite dramatically here over the last couple years. In blue, that is showing how people responded to the question of how would you describe current new vehicle inventory levels. And you can see that it was in quite the doldrums when we had the very lean inventory environment starting in the spring of 2021. But it's since recovered quite nicely. And in fact, the view from car dealers today essentially matches what their view was on inventory prior COVID hitting the marketplace. And when we ask dealers, how would you describe profits over the last 3 months, and that's in green, you can see the heyday that everyone enjoyed back in 2021 and 2022 is a little bit weaker today. The profits don't seem to be quite as strong, but they still remain above pre-COVID levels, at least as stated as a viewpoint from the dealers themselves. So there is still some optimism out there, and the profitability still looks fairly strong from the dealer network. But one of the interesting issues that we're starting to see out there is that uh, some of the factors that are impacting the business are starting to change. And the most important one, or at least the most significant change that we saw since the first quarter of this year, was credit availability for consumers. That's gone up significantly from where we were before, and it's not surprising. With as we see this yield curve inversion, it is expected that many banks are going to start to pull back on lending and be a little bit tighter with their wallets because they are concerned about the potential of folks out there not being able to repay those loans. Interestingly, the other one we see is that the political climate has become at least a major concern and thought to be a factor holding back business for dealers. A lot of that turmoil around former President Trump and all of that, I don't know what we call it these days, but that news is weighing on dealers out there. So that's certainly something folks are concerned about. But that auto lending part is really in a critical point, and I think dealers are rightfully right to be concerned about where this is headed. This is data that's coming from the New York Federal Reserve Bank, and it's showing the total amount of loans being made, auto loan originations, in billions of dollars. And the key point here on the far right is that in the second quarter, the amount of lending done was down 10% from the same quarter a year ago. And in fact, over the first half, loan originations were down about 9% on a year over year basis. But on the plus side, the credit availability still remains quite strong. Excuse me, the quality of the lending still remains quite strong. The role of subprime is down substantially. And that's what that red jaggly line there is. If you look back during the Great Recession period, we saw subprime was nearly 30% of all of the vehicle sales out there. But our most recent data point shows this has fallen more towards the 15 to 16% range. So the folks that are borrowing money out there are people with much better credit ratings, probably higher incomes, and probably a little bit more insulated from some of the economic turmoil that we've all been dealing with. In terms of the quality of this lending, it does not appear to be under too much risk, at least at this point. And that's something we can see in the delinquency rates. This is a chart from Equifax that's looking at the delinquency rates on auto loans, and these are severe delinquencies. So folks that are 60 plus days behind on paying their monthly car note. And we can see in yellow, delinquencies are really at a level that they haven't seen since the Great Recession. In fact, they're even higher. So delinquency rates have really spiked quite a bit. But the red line is showing what has defaulted, what's actually gone to the default stage. And you can see it remains far below the levels that we had during the Great Recession. And so there's no doubt that things are getting tight out there. It's getting difficult for folks to make these payments. But at this point, they're still able to make those payments. And so we're not seeing the default rate rise just yet. But one of the things that we are keeping an eye on is the student loan issue, because the holiday of not paying that is going to expire. And so a lot of these folks that have been using that extra money that have been going to paying student loans to paying their car notes may have to reverse that. And so it may get a little bit more difficult for folks to make that monthly payment. So we could see defaults rise some here later in the fourth quarter. So on the whole, though, we know that the interest rate out there is going up, and we know that the interest rate that's being offered on car loans has been going up. This is from our dealer track data, and it's showing the average new vehicle purchase contract APR. And you can see that from where we were back in January of 2022 and where we are today, it has risen dramatically. And in fact, in just converting that to its impact on that monthly payment, for a $40,000 6-year loan, just the interest rate change alone is adding nearly $60 a month to that monthly payment. And so that's not even including the actual vehicle price itself changing. In response to that, consumers are changing the way that they're financing these vehicles. We're seeing the role of cash, people who come in and actually just slap the $40,000 or $50,000 down and buy that vehicle with cash, has risen significantly from where we were prior to COVID. And this would make sense. if you're going to be charging me 7.5, 8% on a vehicle loan, and my bank's only going to give me 2 or 3 or 4% interest rate in my savings account, I might as well pull that money out and just pay cash for that vehicle because that would make more economic sense. And as a result of that, we've seen that the cash share of purchasing out there has gone up from 12 to now 20% of the market, and it's even ticked up a little bit for used vehicles as well. But this is the aggregate. This is the national total. We have to look under the hood to see how different it is among the different manufacturers. And here's where things I think get kind of interesting. That when we look at what the average APR is year to date for the different major brands out there, we can see there's wide variation. On the far left, you have a Honda and Subaru. The average APR that their customers are paying for on a loan is in the 4.5 to 6% range. Quite far below the national average. And if we look on the far right, you can see Jeep, Ram, Chevrolet. Their average APR is well over 8%, well above the national average. Uh, One way to interpret this, or how I'm kind of interpreting this, is that the FICO score could kind of be viewed as a proxy measure of the income level of the borrower. And in generally, folks that have maybe leaner incomes, aren't as credit worthy, they're going to have a lower FICO score. They're not going to be able to get the best interest rates. While those with higher incomes and best credit, they're going to get the best interest rates. And so we can see on this chart here that those brands on the far right may be more vulnerable if we have some sort of an economic downturn because they cater to a customer base that's paying a much higher average APR and thus probably have a lower FICO score. So all of this is related to the interest rate, but we also know the monthly payments themselves have been rising dramatically. And I know I've shared this chart with you before, but I still think it's kind of interesting to look at monthly payments and how much they've changed in this post-COVID market. In green, I have the average monthly payment for a loan, and in blue, I have the average monthly payment on a lease. And we can see that from March of 2020 to December of 2022, we went through this period of COVID-flation where monthly payments really started to rise dramatically and are now standing at around $780 and $620 for loans and leases. But loan payments during that COVID period rose 30%, and lease payments went up 28%. Normally, we have about a 3 to a 4% annual increase. So this was well above what we see as normal levels. And so all of this has put affordability, particularly in the potential of a recession on the horizon, has put affordability front and center as a major threat to the vehicle market. But again, just this is looking at the national totals. We have to look under the hood to see the different brands and how varied it is out there. And this is looking at what the COVID-flation period, that March 2020 to December of 2022, what was the average loan payment change for the major brands out there? And we can see on the far left, Subaru, Kia, they only had relatively modest increases in their monthly payments. They didn't see a huge shift towards more expensive products and huge increases in their prices. And as a result, their monthly payments have only gone up less than 20%. But on the far right, we have Ford, Jeep, GMC. They've seen huge increases in their loan payments. So, GMC almost 45% increase in the average loan payment during that COVID-flation period, well above the national average. Again, one would think if we do have some sort of a downturn in the market, those brands on the far left, Ford, Jeep, GMC, may be more vulnerable because they've asked for such a huge change in payment levels from their customer base that they may be more vulnerable if some sort of economic downturn does come. So let's talk about the new and the used markets and give you an update to what's going on there. Let's talk brand sales year to date. Because really there's so many stories that are really impacting vehicle sales this year. But we can see here on the left, I'm looking at the big brands here, at least the non-luxury brands, and we can see that nationally we're up about 13% year to date on sales. But not everybody's seeing sales rise. We can see Jeep, Mitsubishi, Toyota, Ram, their vehicle sales are actually negative on a year-over-year basis. While other brands like Nissan, Mini, Honda, Mazda, their sales are up quite a bit. And much of the contributing factors to this can be attributed to the changes in the monthly payments, as I just showed you, the changes in the interest rates, and the changes to underlying available inventory. There's a lot of contributing factors are impacting all of this. Toyota probably remains a very constrained manufacturer still. They haven't gotten their inventory levels quite back to where they need to be. And so that's probably having an impact on their sales. Honda and Nissan are seeing strong sales gains because their inventory levels have improved dramatically from where they were last year. And when we look at the luxury brands, it's a similar story as well, where you have Lincoln and Jaguar and Mercedes, their sales down on a year-over-year basis, while we can see that Tesla, Acura, and Infiniti are looking at huge gains in sales. Again, underlying inventory and the improvement in inventory has been a major contributing factor to year-to-date performance so far. So let's talk about the overall inventory and where we're at today. This comes from our vAuto data, and on the left we can see available supply, or the sum of what is on dealer lots and is in transit around the country. And right now you can see that we're up about 68% in terms of available inventory of where we were this same week last year. So the inventory level has improved dramatically, and you can see that that red line from last year, it really started to shift upward around August of last year. And we've really been on an upward trajectory since then, as the supply recovery uh, and the chip shortage issues have worked themselves out. And many factories are now back to pre-COVID levels of production. But the key is how long will this inventory last? And that's the days of supply. And that's what we can see is that it's up 45% from where we were the same week last year, that yellow line. But what's important to point out is that yellow line, for the most part, has been fairly stable this whole year. We've been hovering sort of in the mid 55 days range, below where we were in the pre-COVID levels. That was more in sort of the 65 to 75 range. So it's a little bit leaner from where we were back in 2019, but it's certainly much higher from where we were back in 2021 when things were particularly tight, and of course where we were last year. But again, this is the national average. We have to look under the hood to see how are the different brands behaving and what's their situation. And we can see that looking at days of supply on the far left, Honda, Toyota, Kia still remain in very, very lean inventory environment, well below the national average. However, on the far right, we can see Lincoln, Chrysler, Dodge. In fact, many of the Detroit three brands find themselves on the far right of this chart, which suggests that as there's concern about the potential of a strike, these brands may not, if it's a short strike, we probably won't even notice it because there's a lot of available inventory that's been building up for many of these brands. So it may not be such a terrible thing for them if the factory shut down and allowed some of this inventory to clear. But certainly everybody's in a very different situation out there, and it's having an impact on pricing. And I'll show you that in just a moment. And just to talk about some of the big selling brands out there, just to show you the variation that we've got. These are the top 30 sellers in the market, and you can see on the far left we've got Honda CRV hybrid, Honda CRV, Kia Forte, Honda Pilot. A lot of Hondas, a lot of Asian manufacturers with their best sellers still in a very, very tight inventory environment. But you can see on the far right, you've got all the big pickup trucks, F-150, Ram 1500, Chevy Silverado, looking at 100-day supply, some of them. So certainly the slowdown in the housing market is not helping. That's taken a lot of contractors out of the market from wanting to buy these products. But all of it suggests that the bread and butter of the Detroit 3 is really seeing inventory levels build. So the potential of this strike it's going to be interesting as to how much pressure the manufacturers really feel, and if they're really going to kind of sit tight on what their offer is. But all of this change in inventory is changing the conditions in the marketplace, and what I had termed before the seller's market is now starting to change. And a seller's market is one when there's no negotiation. Basically, the MSRP is the price. And that's not normally the case in the new vehicle market. The blue line here is showing the incentive as a percent of the transaction price. And we can see that prior COVID and back in 2019, this was sort of in the 10 to 11% range. That was the average incentive relative to the transaction price. Then around the spring of 2021, we had the supply crunch really start to hit the market, and the dealer shelves were cleared. They couldn't replace that inventory because of the supply chain constrictions. And we saw incentives pull back dramatically to just, on average, to just 2% of the transaction price. But now you can see since the fall of last year, it started to rise. And so there's a little bit less pricing strength out there. The manufacturers have started to increase their incentives to keep those inventories from building too high. The other measure we can look at is the price strength, or what was the transaction price relative to the MSRP. And that's the line in green. And we can see prior to COVID, that was in the neighborhood of around 94, 95% was the transaction price relative to the MSRP. Then we got into this lean inventory environment, and that rose up near 102%. So really, it was the transaction price plus your destination charges was going to be the price of the vehicle. There was very, very little negotiation going on, but we can see since fall of last year, this too has started to weaken. So, although the pricing still remains more favorable to the manufacturers, it's certainly they're certainly more favorable to where we were prior to COVID. It has weakened from where we were just over a year ago. But again, that's the national view. We got to look at the individual brands to see what's going on out there. And just like we see with the inventory levels, that's having an impact on the discounting as well. This is showing the incentive as the percent of transaction price. And I'm showing where we were in August of last year and what we had in July. That's my most recent data point. And you can see that for everybody, incentives are rising. They're higher across the board of all these major brands. The incentive levels had gone up, but you can see some brands are making some dramatic changes. Jeep and Hyundai are really starting to get much more aggressive on their incentives, while Toyota still remains relatively tight with their pricing. They are not doing substantial discounting. And so again, that's sort of reflecting the lean inventory environment that they are in, that they're able to hold pricing much more firm. Our expectation is that as we move through the course of this year, we're going to continue to see discounting rise as the manufacturers are going to have to offer better deals to the consumer out there in the wake of the headwinds and the rising interest rates that we're expecting here to continue through the course of the year. So let's jump in to talk about the used vehicle market. Used vehicle sales are actually seeing quite a bit of a surge over the last couple of months, where that's now at the most current data point that we have is that sales are now running about 7% above where they are last year. So this is a weekly data point. If we look at year to date sales, the used vehicle market on the whole is running down just a little bit, maybe a percentage point from where we were last year. And I think that's relatively surprising that used vehicle market is holding up this well in the wake of the massive increase in interest rates that we've seen here in the U.S. economy. One would think that might chase away more buyers than it has. But the reality of the lean inventory environment that we have on the new vehicle side, coupled with those high vehicle prices that we know exist on the new vehicle side, has likely chased a lot of folks into the used market. That's the only place where they can find a product that they can afford. And so that's mitigating some of the losses that we might have had otherwise from these rising interest rates. And just looking at new vehicle inventory, on the new side, we saw that inventory is much higher, but on the used side, we can see that inventory remains far below where we were last year. At this point in time on the left, we can see that available supply is down about 9% from where we were at the same point last year. So the dealers out there remain relatively lean and mean in this environment. And in fact, you can see if you look at that red line, they've been allowing supply to get tighter and tighter since the spring of last year. So were not in a situation where they were acquiring a lot of inventory and are now in a situation where they have to do a fire sale in order to sell these vehicles. So that's allowed vehicle sales to kind of hum along as well as they have. Days of supply, you can see that's currently down about 15% from where we were last year. Again, reflecting this relatively lean environment that we have for dealers regarding their inventory. And part of the reason that sales have been humming along is that the price of vehicles has come down from some of the high levels that we had before. This is looking at used vehicle list price, and this comes from our vAuto data. In that blue line, you can see that was back in 2021. That was really that huge run up that we saw, and it can all be correlated to the tight inventory that we had on the new vehicle side. The fact that folks still needed personal transportation and they couldn't find it in the new vehicle market pushed a whole bunch of buyers into the used vehicle market, and that led to used prices really rising dramatically. What we can see though is that from where they were in 2022, they were essentially, flatline through much of the year. But this year they're down just a little bit, and they've been holding it down about 5 or 6% range from last year. But we do not see any collapse in prices. Uh, the strong demand out there and the lean inventory situation that the dealers are in is not one that would suggest that we would see vehicle prices start to collapse. But certainly, if we do get into a more pessimistic environment with the economy, it is possible that we could see consumers pull back substantially. But we don't really expect that to happen because people still need to get to where they need to go. Whether they like it or not, they still have to buy vehicles. And if you can't afford the new market, then you have to come to the used market. And so, in many ways, consumers are stuck out there. There's no way to escape the situation that they're in right now. But we are starting to see at Manheim on the wholesale level that prices are starting to come down. Our most recent data point, and we're going to have the new data point released tomorrow. But what we saw through the mid-month is essentially the Manheim index was flat from July in terms of prices, but it's still falling from where it was a year ago. And in fact, we were down nearly 12% from where we were last July, our most recent published data point. So prices are down, and so that's sort of being reflected on the retail side as well. Our expectation is that by the time we get to December of this year, the year-over-year difference in prices is going to be pretty close to zero or down just a little bit, about 1%. So we think that the prices are going to sort of stabilize a bit from here and not fall quite as much. And when we look into 2024, we're expecting used vehicle prices to get back on the plus side and rise a little bit over 2% next year. And part of the reason that we expect that pricing is going to stabilize and actually start to get positive again is because we are in a lean inventory environment, and that's not going anywhere anytime soon. We can look at the future supply of used vehicles, and we know that it's going to be quite constrained over the next couple of years. The fewer new vehicle sales and the substantially less leasing activity and fleet activity that we had done back in 2020 and 2021 and 2022 are going to have ramifications for the used market for the next few years to come. And in fact, we expect, this is a chart that's showing off lease maturities, and you can see that we're expecting these to decline from sort of the 4.1 million a year that we were averaging back in 2019 and 2020. Though there's going to be substantially less. And in fact, when we look to 2023 through 2025, we're expecting 2.5 million fewer off lease maturities than we had from 2020 to 2022. So the future supply of used vehicles is under threat, and all of that is helping to keep used vehicle prices from falling much further from where they are today. All right, so let's talk about EVs and reaching the takeoff stage. This is a chart that's looking at EV sales that are out in the marketplace today. So far, year to date, they're running close to 7% of all vehicle sales are an electric vehicle. And it's really been rising dramatically. And certainly the key driver of this has been the success of Tesla, and particularly the Model Y. That's quickly become the best-selling luxury vehicle out there, and that's really been driving up electric vehicle sales. But they're going to have a lot more company in the next couple of years. There's going to be a lot more product that's coming, and EV sales are likely to continue to rise very, very quickly. And one of the main reasons is from the Inflation Reduction Act. The Inflation Reduction Act was passed last fall, and one of the measures in it allows for a $7,500 rebate on an electric vehicle if you purchase that vehicle. But there's all kinds of requirements in order to qualify for that $7,500. The vehicle had to have been made in the United States. You have to make below a certain level of income. The battery had to come from sort of a friendly country, if you will. So there's all kinds of requirements to purchase that vehicle. But one of the interesting things about the Inflation Reduction Act is that commercial vehicles do not have to meet these qualifications. And what the IRS had ruled is that leasing of vehicles is considered a commercial sale. So the expectation is we're going to see a lot more leasing offers for EVs because they can offer that $7,500 as a capital cost reduction. And just to give you an idea of what kind of impact we're talking about, on a $50,000 vehicle with a 36-month lease, you're talking about a $222 savings as a result per month as a result of that capital cost reduction. So the expectation is that we're going to see a lot more leasing of EVs, and I think that makes sense too, given the uncertainty around this technology and consumers' lack of familiarity with it. Leasing may be the right approach to these vehicles till consumers get more acclimated to what an EV is all about. But we know there's going to be a lot more vehicles coming. This is just a quick little slide showing all the different brands and the number of products, of new EV products we're expecting to come to market. 33 new vehicles this year, 37 next year, another 34 in 2025. A whole bunch of product is going to be coming to the marketplace, and that's going to give quite a bit more selection for consumers who may not have been attracted to the sort of the handful of relatively affordable EVs that are out there today. So there's going to be a lot more product to choose from, and that's certainly going to be a contributing factor. And it's becoming more important for the manufacturers themselves. This is a chart that's looking at EV share of brand sales. And in green is what EV share was back in 2022, and in blue is what EV share is so far this year. And you can see that for Volvo, EVs were about 8% of their sales last year, and now they're over 12%. Volkswagen, it was about 3%. Now it's approaching 12%. So EV is becoming a very important product for a number of brands out there. But on the far right, you can see there's still a number of brands, Honda, Jeep, Ram, that still have no EV offering. And so as we go through this EV revolution, there are some brands, and particularly Toyota is a big brand, that may be vulnerable because they don't have the product right now to meet this rising tide of interest in EVs. And why I say that there's going to be liftoff is there is precedence to suggest that there is such a thing as getting to a liftoff stage when it comes to EVs. Bloomberg put a story out last week, and I pulled a couple of charts off of what they published. I think it's kind of interesting, but the key takeaway is that once a country passes the 5% share of EV of the market, sales really start to take off. And the reason being is that generally you have sort of the early adopters, the people who are willing to take on new technology and are willing to take the risk of what this new product is. And they drive around in vehicles, and we all kind of look at it and go, wow, that's kind of interesting. That's kind of interesting, but it's not for me. But once it gets to a point where it's about 5%, enough people have adopted it that it becomes accepted, that people start seeing, oh, yeah, this is really going to happen. And that's sort of a bandwagon effect, and more consumers are interested in purchasing these vehicles. And if we look on the right here in the progression that some of the countries went through, we can see that it can happen quite quickly, that EVs can really start to take off. We can see, for example, Norway in Q3 of 2013, they passed the 5% threshold of EV sales in their market. 10 years later, it's now 82% of all vehicles sold are an electric vehicle in Norway. In Germany, they passed in the third quarter of 2020 the 5% mark, and now they're approaching 18% of all vehicles sold being an EV. And in China, they passed it in the fourth quarter of 2018, and now they're approaching 17%. So the U.S., we passed that 5% threshold back in the fourth quarter of 2021. The outlook suggests, following this precedent, that we could see EV share quickly rise to a quarter of the market over here in just the next couple years. And so that's why all this talk about the EVs and kind of dominating the media news is because the precedence is that, yes, these things aren't going to start taking off. But again, that's the national view. We got to look at underneath the hood and see what's going on in all the different states in the country. And so I pulled the EV share down for all the different states in the union. And nationally, I looked at EV sales relative to retail sales, not total sales, which was on the earlier slide. But nationally, EV sales share of retail sales are about 8%. So I looked at what states are above the 8% threshold, what states are in the 4 to 8% EV penetration rate, and what states still have less than 4% EV share. And you can see that the West Coast is really seeing the EV share is quite high. And in fact, California, 23% of all vehicles sold so far this year are an electric vehicle, well above the national average. But across many states, including Texas and Florida, they're sort of in that intermediary takeoff stage. But there's lots of parts in the country where it's below 4%, including my home state of Michigan. So they're still in the infancy stage of electric vehicles. And so it may be take a little bit more time for these vehicles to take off in some markets around this country. But clearly the outlook suggests that they're going to start to rise everywhere. But again, the rate of ascension is going to vary greatly depending on where these different states are today. But one of the obstacles I can see to this is that leasing is not a national product. As I showed you on the earlier slide, that leasing seems likely to be a mechanism that the manufacturers are going to employ to really try to get folks to get into these electric vehicles. Leasing is not something that's common across the country. Nationally, it's about 20% of all retail sales is a lease, but that's not the case everywhere in the country. And you can see that in Michigan, New York, New Jersey, it's 40 to 50% of all sales is leasing. But in Alaska, Arkansas, just a fraction of retail sales are leasing. So one would think it's going to be a pretty tough sell. You got to convince folks in many southern states, for example, in western states, to buy this electric vehicle, a new product that they've never heard of, don't understand, don't know, and you're going to rent it. You're not going to buy it. That's a foreign concept as well. So it's sort of a double whammy. You're going to be asking buyers out there in many parts of the country. That may be a tough sell. So I think it's going to be a challenge out there. The education that's still yet to come that has to happen for consumers to really see EV adoption become universally accepted everywhere across the country. But one thing we know for sure is that the used EV market is going to grow. And this is looking at used EV retail sales by quarter. We're now approaching 1% of all retail sales activity is an electric vehicle. And the outlook for this is just to continue to rise. And one of the things that we know is that the Inflation Reduction Act does allow for a $3,500 credit as well for a used EV sale if the EV did not get that credit when it was sold as a new vehicle. So there is potential out there to also help make these EV sales go along even faster thanks to the IRA. But clearly the outlook is that used EV sales are going to rise dramatically. And so I think it's going to be a challenge for dealers out there to be able to sell these used EVs, because this is something that consumers are going to be interested in. So having a charger and the ability to service these vehicles is going to be important at dealerships around the country. But as I've shown you guys before, I think we got to keep in mind that all of this talk about electrification, it's going to be a long time till we see electric vehicles take over the vehicle fleets here in the United States. We currently have 280 million vehicles on the road here in the United States. 99% of them use gasoline or diesel. And so it's going to take a long time to kind of wean this country off of gasoline vehicles, and that those 280 million vehicles get taken to the junkyard. We know that the average vehicle age is over 12 years. And so people are hanging on to these vehicles for longer than ever. And so there may be even more reluctance to kind of give up that gasoline vehicle to buy an electric vehicle. They might hang on to them even longer. And the recent run up that we've had in used vehicle prices suggests that the value of the used vehicle has gone up substantially. In 2019, a 12-year-old vehicle at wholesale was selling for about $3,900. In 2022, it was selling for about $5,500. So over a 40% increase. That increase in value would suggest that it would make more economic sense to keep this vehicle running. It would make sense to spend that $4,000, $5,000 to get that transmission fixed or get that engine replaced if I can get another year or two use out of that vehicle. And so it's just something to keep in mind, that as we move to electrification, dealers are going to have a wide variety of capabilities in their fixed ops departments in order to be able to service all of these new technologies, these new electric vehicles, as well as all of the fancy driving assist components like lane departure warning and uh, uh, adaptive cruise control, all of those things, and also have the technological capability to clean a carburetor because we're going to need the old stuff and we're going to have to be able to do the new stuff. And that could be a big challenge because there's a lot of old vehicles out there in the vehicle population. Over 130 million vehicles are over 10 years old. They're going to need servicing for a long time. And one of the issues I do like to just point out to people to keep in mind, we just went through a major chip shortage issue for the new vehicle market here over the last couple of years. What's the future look like for chip supply? Are the chips going to be available to repair these vehicles in the future? Your air pressure, your tire air pressure system has its own chip. Your rear window, automatic rear window, has its own chip. There's many chips on these vehicles, and are we going to have backward compatibility? Will we be able to find replacement chips to repair some of these components in the future? Considering it seems unlikely that compatibility with new technologies and new developments, will chip manufacturers continue to provide supply of these old chips? And will the future junkyard of tomorrow be one of a shoebox full of all of these old chips as opposed to a bunch of rusted out vehicles in a big field? So those are my comments. It does look like, as I said, we should be cautiously optimistic. The outlook still remains positive, but there's certainly some concern out there that a recession may be on the horizon. But as I said, the vehicle market seems to be in a fairly strong position where the dealers are not looking at huge levels of inventory. The manufacturers are still keeping incentives relatively low. So there's a lot of levers that could be pulled by the manufacturers if they feel necessary. They could start to discount much more aggressively than they have already if they feel it's needed to kind of move the metal. But at this point, it does seem like the outlook still remains cautiously optimistic for the rest of this year. If you're looking for more information, Cox Automotive has the Cox Automotive Newsroom. We publish all kinds of stuff. Our chief economist, Jonathan Smoke, is always publishing comments and other news stories. I urge you to visit there frequently to try and stay up to date with some of the topics that we're talking about here at Cox Automotive. So with that, I'd be happy to address any questions if we had any.
Charlie, we had one question come in. Does EV mean 100% electric or any hybrids being included in the data?
Yeah, that's pure EV. So we have seen, what I've been showing is pure EV. We have seen that hybrids have seen a big increase in sales, really kind of a very similar trajectory to what we've seen with EV vehicles. But the data I've been showing has been strictly the pure EVs.
Got it. Well, Charlie, thank you so much for joining us today. What a great presentation. I really look forward to these updates, and I'm glad to see that things are starting to look up. Again, to those on the line, you'll be receiving a copy of this webinar by early next week. Join me back here on Tuesday, yes, this coming Tuesday, September 12th, as ACB talks to the art and science of the used car appraisal. For more information about AIADA, visit aiada.org. Thanks for tuning in and have a great day, everyone.